In this video, we're going to talk about using the daily bias to help filter trades on a lower time frame. This will help you become more profitable. With just a few tweaks to your trading system, you can dramatically improve your results. For example, in my Ichimoku bounce video, I showed you how you can use the higher time frame to filter out bad setups. We took 36% fewer trades, but profit went up 47%. Less work and more money. It really is the best of both worlds. If you missed that video, click here. One of the comments to that video had another idea on how to sort these signals. It says, have you tested wait for Chikou? So Chikou is the Chikou Span, which is the same as a lagging span. Have you waited for Chikou to cross across the cloud? In my backtest, it cancels a lot of the bad trades. Chikou often bounces at the top of the cloud. If you're not familiar with the Chikou Span or how the cloud is calculated, check out the video here. Let's go to the charts and see what he's asking. Here we have a valid Ichimoku bounce trade on the 4-hour. Future cloud is green. The last candle was below the faster moving average, but we just closed above it. Faster moving average is above the slower. Price is above both moving averages and the current cloud, and then the lagging span is above price. We decided to take the trade and we're pretty happy so far, up 47 pips. All of a sudden, price starts to turn around. The faster moving average can't hold. Price goes through the slower moving average, through the top and the bottom of the cloud. When all is said and done, price dropped over 300 pips. Was there anything on the higher time frame that might have served as an early warning signal? The comment suggests there is, so let's go back in time and examine the trade on the daily time frame. Here we're back at our entry on the 4-hour. Now let's switch over to the daily. On the daily, we actually have a Kumo breakout. The last candle was below the cloud. Now we're above the cloud. Future Kumo is green. Faster moving average is above the slower, and price is above both moving averages. In addition, the lagging span is above price. Flipping back to his comment, his idea is to wait for the Chikou to actually cross across the cloud. He notes Chikou often bounces or gets rejected at the top of the cloud. So it is true the lagging span is above price, but take another look. Notice how close Chikou Span is to the top of the cloud. His idea is to wait for it to clear the cloud. The risk we have now is the top of the cloud could serve as resistance. So at any of these points, price could get pushed lower. And in this case, that's exactly what happened. When price is above the cloud and we're long, this is typically a good situation for us because there are several safety nets that can catch price. Here, price can stop at the faster moving average and then continue up. We've seen in other videos, price will often retrace 50% to the slower moving average before it continues upward. The top of the cloud can also serve as support. And finally, the bottom of the cloud can provide the last line of defense. This large red candle broke through the moving average top of the cloud and pierced the bottom of the cloud, but bounced right back up. The next candle tested the bottom of the cloud again, but once again found support. Price moves back to the cloud, but it's able to hold. Retest the cloud, but still doing its job. Once again hits the cloud, but bounces off. We get a Kumo breakout to the short side. A nice push down. Price retraces to the cloud. The Kumo holds and we continue on our merry little way down to more profit. This is another example of how the cloud can be a strong force. We made 158 pips before price turned around. It paused at the Kumo and then turned back lower for another 150 pips. The 4-hour and daily time frames may or may not agree. Here we have a long bounce signal in the 4-hour. Let's switch over to daily to get the full picture. Looking specifically at the lagging span, this may be double trouble. As soon as price moves up, it's going to hit the bottom of the cloud, and right after, the top of the cloud may push it back down. Here we have a short signal in the 4-hour. Looking at the daily, we see price inside the cloud. When it comes to the bounce, so far we've seen trades fall into 3 groups. The 24-hour lagging span can agree with the 4-hour signal. The daily lagging can be inside the cloud, or the 24-hour lagging can give the opposite signal. We'll have to run the numbers for sure, but logically would make sense. The best case scenario is when the 4-hour and the daily line up. The worst is when the daily and the 4-hour are fighting each other. When the Chikou Span is inside the cloud, it could be good or it could be bad. It's hard to say at this point. We went over all these 4-hour bounce trades in a previous video. I went back to each of these and cross-referenced it with a daily chart. I labeled them as 1 if it's an opposite signal, 2 if the daily lagging is inside the cloud, and 3 if the 24-hour agreed with the 4-hour. Going back to his question, I hope you now understand what he meant when he wrote about waiting for Chikou to cross across the cloud. Cancels a lot of the bad trades by avoiding Chikou bouncing off the top of the cloud. Essentially what he's saying is he's found most success when the 2 time frames line up. We're on the 4-hour and we get a long signal. When we switch to the daily, he wants to see the lagging span above the cloud. If we're short on the 4-hour before he takes the trade, he wants to confirm the lagging span is below the cloud. He's suggesting we could potentially eliminate entire groups of trades and be better off for it. One point I want to touch on without glossing it over. Notice here it says, in my backtest. Before I dive into the numbers, I'd like to take a second and compliment this subscriber. He's done his own backtest and came up with his own numbers. I'm thankful for every viewer and hopefully I can give you some new ideas. But trust me, when you confirm on the charts for yourself what I or anyone else on YouTube tells you, you'll have much more confidence in your strategy. You'll know it's a long-term winner. When you're all alone in a live market and your last 2 trades have been losers, you won't get emotional and do something stupid. You'll know this is totally normal. You've seen it happen many times in practice. Let's go back to his post and flesh out one more of his ideas. The other point he brings up is when the daily is close to resistance. What he's saying is it might be important to not only know if the lagging span agrees with the 4-hour signal or not, but we also want to know to what degree. For example, in the 4-hour we get a long signal, but when we switch to the daily, the lagging is below the cloud. Now, it might matter if the lagging span is butting right up to the cloud, or the cloud is here and the lagging is way down here. The goal of this backtest is to look at these contradictory signals and see if we should avoid all these trades, or if there's a way to keep some and throw the rest away. The way we'll do this is by first splitting the trades into 3 groups. When the 4-hour and daily agree, when they're on opposite sides of each other, and when the 24-hour lagging is inside the cloud. We'll further split these last 2 groups based on how close they are to the cloud. Our data set contains over 1,000 trades across all 7 of the major forex pairs. Some of the forex pairs are more volatile than others, so we need a way to standardize the distances so we're comparing apples to apples. The way we're gonna do this is by using the ATR indicator. Come with me to the charts, I'll show you what I mean. Here's the first trade we looked at. On the 4-hour, we're bullish. Switching over to the daily, we see the lagging span is below the cloud, which is an opposite signal. We said before that price was very close to the cloud, but close can be a relative term, so we want to actually assign a number to it. So here the lagging is 0.00029 or 2.9 pips away. If price moves straight up, we want to know how many candles it'll take for the lagging span to hit the cloud. The way we're going to do this is by using the ATR indicator. Here the ATR is giving us a value of 0.00417 or 41.7 pips. During any given 4-hour period, AUD US dollar moves up or down 42 pips. When we do our ratio, the 24-hour cloud distance goes on top, the 4-hour ATR goes on the bottom, and we get an answer of 0.0695. When we run the numbers, we'll be able to determine if we want a big or small ratio. Here on NZD US dollar, we want to go long on the 4-hour. Looking at the daily, we see we have another opposite signal because the lagging span is below the cloud. Visually, we can tell this is much further away than the last example, but we want to have a ratio to compare it to. First, measure the distance to the daily cloud. We get 0.03378 or 337.8 pips. Going back to the 4-hour, we have an ATR of 0.00196 or 19.6 pips. The last example, we had a ratio of less than 1. Here we get 17. Or in other words, on average, it'll take 17 4-hour candles for the lagging span to hit the cloud resistance. And that's if every candle is bullish. Visually, we could tell it was much farther away, but now we have a number to use when we run our statistics. So before we run the numbers, if you had to make a guess, when the daily and the 4-hour contradict each other, would you rather see the lagging far away from the cloud or pretty close to it? I can show you dozens of examples where the lagging span is close to resistance and it does in fact get rejected. On the other hand, there's plenty of examples where price has built up so much momentum that it blows right through the cloud like it doesn't even matter. For me personally, I wouldn't feel comfortable risking my money on just an idea or a guess. I want to know what the data actually says. At a baseline, we see we have a little over 1,000 bounce trades, and the profit for both TK and KJ are a little over 100R. We described the 3 different cases before. Now let's see how often each one happens. Here we see the daily and the 4-hour only agree about 55% of the time. A third of the time they give opposite signals, and 11% the lagging is indecisive when it's in the middle of the cloud. Now that we know how often these events happen, let's see how much each of these contribute to the overall profit. For TK, the faster moving average, we see that we actually generated a profit for all 3 categories, and the same for the slower KJ moving average. However, you'll notice that the means when the 24-hour and 4-hour are opposite are pretty small compared to the other 2 categories. Let's scroll down and view it visually. For the faster moving average, it is true we generated a tiny profit when the signals are opposite, but the vast majority of our profit came from the other 2 categories. The same is true when we trail with the slower moving average. The opposite signal was basically break even, while the other 2 did great. Once again, we had about 100R profit. Let's see how much came from each category. Here we're only going to select the first cases, which we said are the opposite signals. Here we see something interesting. Let's look at TK, the faster moving average. When the 4-hour and 24-hour signals contradict, these make up 34% of the trades, but only contributed 1.7% of the profit. That sounds like a lot of work for very little return. The KJ slower moving average also showed an underwhelming performance. We spent a third of our time in these trades, but only gained 9%. When the 24-hour lagging is inside the cloud, we gained 30.5% of our TK profit and 13.8% of the KJ profit. By far, the most money happens when both signals agree. 67.8% of total profit for TK and 76.8% for the slower KJ happen here. As we look at the numbers from different perspectives, we're starting to see the cream rise to the top. We could cut out 34% of our trades in the case of the TK moving average, and we'd only lose 2% of our profits. From my perspective, that's a good trade-off. But I'll keep analyzing the data, see if we could actually increase our earnings. Let's go back to the subscriber's idea about using the distance from the cloud. So let's say we're long and price is here, 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 or here. When we're long and price continues to go up, the cloud doesn't come into play because it'll never act as resistance. What we're really interested in is if there's a difference between these two cases when the Chikou is inside the cloud, and if it's better to be closer to resistance or farther away. In the same way, when we want to go long the 4-hour but get an opposite signal on the daily, we want to know if there's a way to make profit by taking one of these signals and avoiding the other. In order to compare results within a group, what I did was order trades by distance of the lagging span from the cloud and split these into 4 groups. I then compared the profits between these groups. For the opposite signals where the 4-hour and 24-hour do not agree, I calculated the quartiles and split them into equal groups of 89 trades. The closest 25% of trades were within an ATR ratio of 3.8. The second group was between 3.8 and 7.1 and so on. Let's compare using TK versus KJ. For TK, the faster moving average, we see most of the profit is in the first quartile. The second quartile is slightly negative and it only gets worse from there. For KJ, the slower moving average, both quartiles 1 and 2 look good, but there's a significant drop off from 2 to 3. The risk with trying to include quartile 2 is if you misjudge where the middle is, you're just as likely to hurt your results by dipping into quartile 3. With TK, it's easy to know when it's close to the cloud, and even if we stray into quartile 2, it won't affect results that much. So for now, let's focus on using TK, the faster moving average, to increase profits. Before we saw there were 357 trades that gave an opposite signal, and since we're using TK, this generated a profit of 1.77R. Using quartile 1, which is still opposite but close to the cloud, we see we took 89 trades and profit jumped from 1.77 all the way up to 21.4. Even if we misjudge how close to the cloud it actually was and took all the trades in quartile 1 and 2, we take an extra 89 trades for a total of 178, and profit would still be 17.6, which is much better than 1.77. So we can actually take opposite trades as long as they're pretty close to the cloud. Now let's look at when the daily lagging is inside the cloud. We had 115 trades total, and I broke these into 4 equal groups. For both TK and KJ, 3 out of the 4 quartiles are profitable. I don't really see a good way to eliminate quartile 2 trades, because then we may be skipping trades from quartile 1 and 3, which are the most profitable. We saw before that taking trades when the 24 hours inside the cloud is highly profitable, so we want to take all of these trades. When we took every opposite signal, we were losing 56% of the time, breaking even 18, and only winning a quarter of the trades. Here for the opposite trades in quartile 1, break-evens are still 18%, so that means we increased our winning percentage by eliminating losing trades. Losing trades are down to 42.7%, and winning trades went from 25 up to 39%. In previous videos, I've laid out my bounce trading strategy on the 4-hour time frame. Click up here if you need a refresher. If you trade Ichimoku on the 15-minute instead of the 4-hour, or if you trade stocks or crypto, your mileage may vary. But from what I've seen, the distance the lagging span is from the cloud does make a difference. Before running the numbers, I thought the worst trades would be when the Chikou Span was closer to the resistance of the cloud. I would have guessed it's better the lagging span was far away and have more room to run. This turned out to be the opposite and shows the importance of backtesting instead of just going with what seems to make sense. To make sure you understand, it's time for a pop quiz. All of these will be valid trades on the 4-hour. I'll switch over to the daily and you decide based on where the lagging span is if you would take the trade or not. Okay, here on the 4-hour we get a long signal, and here's the daily. Would you take the trade? 4-hour was bullish, so we want to see the lagging above the cloud. It is, so we would take the trade. So this time we get a short signal on the 4-hour. Here's the daily. Do you still like the trade? Similar to the last example, this one agrees as well. The lagging is below the cloud, which is what we want to see for a short signal. So yes, this is a good trade. On the 4-hour, we get a bounce to the long side. So notice the lagging is inside the cloud now. What do you want to do about this? There's no need to measure. We take all the trades inside the cloud. Here on the 4-hour, we want to go short. So based on the daily chart, would you take the short trade or let it pass by? Once again, the daily lagging is inside the cloud, so we take all of these trades. On the 4-hour, we get a short signal. Based on the daily, what would you do here? First thing to notice is on the 4-hour, we're going short, but the lagging on the daily is above the cloud. So this is an opposite signal. When we have conflicting signals, it's important to know how close we are to the cloud. So on the daily, we're 0.04135 or 413 pips away. Switching back to the 4-hour, we have an ATR of 0.00263 or 26 pips. So we've got our two numbers here. When we do the ratio, which number goes on top and which is the bottom? So we get a ratio of 15.7. What does that mean? We only want to take trades that are close to the cloud. And if you recall, close means a ratio of 3.8 or less. So we would pass on this trade. On the 4-hour for GU, we get a long signal. On the daily, do we agree or is this an opposite signal? Since on the 4-hour we were bullish, we want the lagging to be above the cloud. The lagging is below the cloud, so this is an opposite signal. What do we need to do now? Visually, it does look pretty close, but we need an actual number to confirm it. On the daily, we're 0.00434 or 43 pips away from the cloud. Going back to the 4-hour, we have an ATR of 0.00772. So here are the two numbers. Give me a ratio and let me know if you would take the trade. The 24-hour distance is divided by the 4-hour ATR. We get a ratio of 0.56. So what does that mean? 0.56 is less than 3.8, so we would take this trade even though it was an opposite signal. We get another bounce trade to the short side. Here on the daily, would you take this trade? It's an opposite signal since the lagging is above above the cloud on the daily, so we can't say for sure yet. We need to know how close it is to the cloud. On the daily, we're 0.00627 or 62 pips away. The 4-hour ATR is 0.00394. So here's your two numbers. Give me a ratio and let me know if you would take the trade. We get 1.59, so is this close enough? We need to be below 3.8, so yes, we would take this opposing trade. Shout out to that subscriber. And if you have an idea on how to make Ichimoku better, let me know in the comments below. When it comes to backtesting, sometimes you confirm what you already intuitively know. It just makes sense. We want the 4-hour and the daily signals to agree, and the data confirm this. But what about when we get opposite signals? This happens about a third of the time, and before we ran the numbers, we were in a catch-22. If we just throw out all these trades, our overall profit goes down. We took over 300 of these trades and only made an extra 2R. On the other hand, if we go with these trades, there's so many of them, it takes a lot of time to manage. But through the power of backtesting, it doesn't have to be either or. By looking deeper, we found a third option that eliminated many of these losers. Because of this, we boosted our overall profit 20R and cut out 75% of the opposite signals. We saw we want to take all trades when the lagging span is inside the cloud. In addition, we can take conflicting signals when the Chikou Span is close to the cloud. I didn't realize this until I made this video, and I hope you learned something as well. This video is a tweak on the Ichimoku bounce trade. If you're unsure how it exactly works, check out my original video here. Or if you'd like to hear 10 life lessons, click here. Thanks for subscribing. Talk to you soon.